Hi, welcome to the Financial Profit. Today we have a very special topic for you. We're going to discuss the week ahead. So please click that like and subscribe button and make sure to stay with us until the very end. Despite the recent tariff-related setbacks, AI growth shows few signs of slowing. In fact, while some speculate that AI spending growth could hit a brick wall soon, the AI train doesn't seem to be anywhere near derailment. On the contrary, Amazon and NVIDIA executives recently dismissed AI growth concerns, suggesting that the segment remains on the right track and is a beacon of light in today's cloudy and uncertain market. Another highly favorable element for the AI tech space is that many high-quality stocks in the segment have had significant corrections. This dynamic has enabled many valuations to come down to much more attractive levels, making many stocks appear much cheaper than they have been in recent history. Here are several examples. So, the MAG stocks have finally become cheap. Alphabet is the first stock we can discuss here. Recent earnings were excellent and considerably better than expected. Alphabet beat top and bottom line estimates, providing about 12% year-over-year sales growth. The consensus EPS estimate for next year is around $10 to $11, implying that Alphabet trades at only about 15 times forward PE multiple. Moreover, this dynamic implies that recently, when Alphabet crashed to about the $140 level, it traded down to a forward PE ratio of only around 12. Dirt cheap for a company in Alphabet's spot. Again, I want to highlight that we see nothing scary in Alphabet's earnings. Moreover, a similar trend can persist with other companies, and all we may see from many high-quality firms is a mild slowdown. Meanwhile, many stocks appear to have priced in a recession and may be strong buys now. So let's continue with examining the MAG stocks. So looking at Alphabet again, the forward P ratio is only about 15 here. The forward PEG ratio is only about 1.5. Now, the stock's peak to trough decline has been about 34%. And around its low point of $140, the forward P ratio declined to only 12.6 in Alphabet. So quite cheap there. Now let's move over to Amazon. The forward P ratio on Amazon here is only 23. The forward PEG ratio, price to earnings growth ratio, is only about 1.15. Now the peak to trough decline here was 35%, and the forward P ratio around the bottom was below 20. So again, very cheap for Amazon. Moving on to NVIDIA, the forward P ratio now is around 18. Forward PEG ratio is around 0.61. Peak to trough decline has been 45% in NVIDIA, and the forward PE ratio around the bottom was just around 14. Now, Tesla, it's a little bit of a special situation stock, so it's going to have a special P ratio as well. So the forward P ratio on Tesla is still relatively elevated, around 70. The forward PEG ratio, however, it's really quite cheap, 1.16 only. Now, the peak to trough decline has been 57% in Tesla stock, which is significant, and the forward P ratio around its bottom was about 50 to 55, depending how you measure Tesla's forward P. Now, Broadcom forward P ratio is around 23.75 here. The forward PEG ratio was around 1.27. The peak to trough decline has been 48%. And the forward P ratio around its bottom was only around 16. Moving on to Meta Platforms, forward P ratio was around 18. It is around 18. The forward PEG ratio is around 1.2. Peak to trough decline was 37%, and the forward P ratio around the bottom was close to 15. Now, moving on to Microsoft, the forward P ratio here is 26, forward PEG 1.7, peak to trough decline 26%, and the forward P ratio around the bottom was close to 22. Apple, forward P ratio 26, forward PEG ratio is around 2.6, peak to trough decline 36%, and the forward P ratio around the bottom was just 20. So the valuation takeaway here is that the MAG valuations, they're very crucial because many stocks didn't simply have corrections, I have to highlight, but We've seen top tech firms going through bear markets here. Alphabet and Amazon declined by over 33% each, dropping by more than 1/3 of their value during this correction process. So we've seen we've seen companies surpassing the standard 10 to 20% correction mark by significant margins. So we're seeing much more than just corrections here. Moreover, Nvidia and Broadcom declined by nearly 50% each from peak to trough, respectively. So really, really substantial declines in the chip leaders here. Tesla dropped precipitously from a high of $488 all the way down to approximately $209. So a substantial adjustment there. Now let's look at some of these P ratios around the low. So we actually discussed that a little bit. While Tesla still appears relatively high, most MAGs have stable earnings, and they became very cheap during the height of the recent declines. So will we see such levels again? We can't be 100% certain here, but it will likely come down to the earnings dynamic and the economic outlook. Now, unless the future earnings and the macroeconomic outlook worsen considerably, we may have seen the lows for many of the MAG stocks, in my view. Even Microsoft and Apple went through mini bear markets, illustrating their steepest declines in years. So, looking at the major averages here, we've seen considerable PE ratio adjustments. Instead of the sky-high valuations we witnessed 1 year ago, we're seeing much more attractive valuations now. So when the S&P 500 was trading around 24 to 25 times future earnings, the market was relatively expensive, which is one of the reasons why now is a much better time to buy stocks than it was 1 year ago. Similar with the NASDAQ here, it was around 30 times forward earnings per share expectations last year, but now at around 24 times forward earnings, the NASDAQ appears cheap. The NASDAQ 100 appears cheap. Also, trading below 24 times forward earnings estimates, the Russell 2000 also appears relatively inexpensive. We could potentially see low multiples give way to a substantial rally down the line as sentiment improves and risk appetite returns to markets. So the earnings takeaway here is that many earnings have come in better than expected. The positive surprises began with the bank earnings early in the earnings season. And we see a continuation of this trend with tech and other sectors. Many of the results, including from Google, IBM, and many others, have been better than expected, implying that the market may have turned overly negative regarding the earnings image for now. This week, we will see crucial earnings from companies such as Visa, MasterCard, Apple, Amazon, ExxonMobil, and other oil giants, and many other top-tier stocks. So the general feeling is that the earnings could continue coming in better than expected, and earnings growth could increase considerably as the uncertainty begins to fade down the line. Now, let's also discuss the crucial economic data that's coming down the line. So this week, we will receive crucial GDP, PCE, ISM, non-farm, jobs, unemployment, and other essential data. GDP data may have held up better than expected, and other essential data as well. Also, the inflation readings may continue to decline as we've seen in prior readings. Now, the most critical reading may be the non-farm payrolls report on Friday, as the market expects an addition of about 125,000 jobs. Now, the Goldilocks read may be around 100 to 150,000 jobs. We don't want a number that is too strong, as it would likely decrease the probabilities for future rate cuts. However, at the same time, we don't want a number that is perceived as being too weak, as it would imply that the economy may be worsening more rapidly than anticipated, raising recession and other concerns. Still, we have to recognize that the market sees many rate cuts ahead. So despite the near-term hawkishness of the Fed, the market anticipates the Fed to loosen up in the second half of the year. Many of the estimates imply that the funds rate will be around 3 to 3.5% by year's end. This dynamic implies that we may see about 100 to 150 worth of basis point cuts before the year ends. Therefore, the recent projections for only 1 to 2 basis point cuts seems nonsensical. There's a significant disconnect between what the Fed projects and what the market expects. The market clearly expects much more than the Fed recently projected. Something will have to give here, and ultimately either the Fed will cave and cut more than expected, more rapidly than anticipated, or the stock market may crater again, which would likely cause increased pessimism, possible panic, and this dynamic may potentially force the Fed or push the Fed to implement a more accessible monetary policy. So let's talk about the technical image here, because technicals are improving, but it's still likely to be volatile in the near term. So while the market has regained much of its post-tariff announcement losses, we are not out of the woods yet. In fact, we are approaching the upper end of the recent technical range as the S&P stretches towards 5,600 to 5,800 resistance. Now, unless we find a tariff solution very soon, a lasting tariff solution very soon, it may be too early to clear this resistance and look toward S&P 6,000 and new all-time highs. Therefore, the current range of about 5,600 to 5,200 may persist in the near term. Also, there seems to be a high probability that we may see the gap fill around 5,300 closing soon. Another element we should consider is a potential retest of the 5,000 to the 4,800 range in a bearish case outcome, and in a potential lower bottom of around 4,500 in a worst case scenario, which, while unlikely, it could occur. So, looking intermediate and longer term, we should also consider some positive future elements and catalysts, like the potential for a lasting tariff resolution, tax cuts, deregulation, fiscal stimulus, and a more accessible monetary policy as we advance. Now, we should also consider that AI demand and other growth catalysts should also persist and could impact economic growth more favorably than anticipated in the second half. So, due to the constructive catalysts and the high probability for a H2 recovery, I am keeping my 2025 year-end S&P 500 target range at 63 to 6,500. I would like to thank you for watching my video. I hope that you enjoyed this week's profit report, and more importantly, I hope that this information helps you make more informed investment decisions down the line. I would also like to hear your comments, so please join the conversation in the comments section below. If you enjoyed my video, please click like, share, and subscribe to my channel. You can also join the Financial Profit, my exclusive investment community on Seeking Alpha. Thank you very much for watching. I hope that you benefited from watching my video. See you next time, and have a great day.